Hello and welcome to the video on long-lived assets, asset turnover, and return on assets using PepsiCo's 2017 annual report. So if we want to look more about long-lived assets, remember we've already looked at current assets. These are those ones that are below these. They have benefits, assets for more than one period. If you notice, it's highly summarized in the balance sheet. So you will see categories, but very, very summarized. First, we have property, plant, and equipment, net of accumulated depreciation for goods that are used in operations that have physical substance. Then we'll see a lot of amortizable intangible assets. These are when you purchase a right, it's an asset, it provides future benefits. You purchased it, but it has a limited life. You have other non-amortizable intangible assets with indefinite lives. And finally, which is something we won't get into too much, is when you have investments in other companies, non-controlled affiliates, that you own enough of them so that you have influence. You might have a seat on the board, but not enough of them that you can tell them what to do or consolidate them in your financial statements. So these are all these things, but we want to learn more. So we say we always need to go to the footnotes. And note 4 of PepsiCo's annual report 10K has the details for property, plant, and equipment. How much of this consists of land, buildings, and equipment? First thing they tell you is historical cost. Even though the net amount on the balance sheet is $17.24 billion, the historical cost, or the original cost of land, buildings, and equipment was $39 billion. And only $1 billion of this is land. That doesn't mean the land isn't worth more, just it might have been bought a long time ago. You'll see that they also give you an estimate of the average useful life. Land doesn't wear out, but buildings and improvements wear out anywhere between 15 and 44 years. Machinery and equipment, and they also include software in here, 5 to 15 years, and the fleet that they use to deliver. Construction in progress is not finished, so it hasn't been put into service for depreciation. We also have accumulated depreciation. So the $39 million was before you took depreciation, charging the cost of the asset to expense over many years. The sum of all the depreciation expense up into the date of the balance sheet was $22 billion, which if you take the $39 billion minus the $22 billion, you get the $17 billion net property, plant, and equipment on the balance sheet. Also, the footnote gives you detail into depreciation expense on this year's income statement, either in cost of goods sold for property, plant, and equipment used to make finished goods inventory, or selling in general and administrative expenses. So what about all these intangible assets? Well, first, there's a relatively small category called amortizable intangible assets. These have these have lives that are limited. You might buy the right to own a franchise for a certain number of years. And net amortizable intangible assets is only about $1.27 billion. What we're going to see for this is we have historical costs, used to be, before we started amortizing it, $2.8 billion. We have an estimate of the useful lives anywhere between 60 years and 5 years for different categories. Accumulated amortization, the sum of all the amortization of the cost of these assets to expense over their useful lives to date, is $1.5 billion. And you'll see 2.8 billion minus 1.5 billion is 1.3 billion. Finally, there's details. How much amortization expense was on this year's income statement? And it was only 68 million, and it was in selling, general, and administrative expenses. Okay, the biggest category, indefinite life intangible assets. A lot of these come onto a company's balance sheet when a company takes over another company. So note 2 on accounting policy says indefinite lived intangible assets and goodwill are not amortized because it's uncertain whether they go down in value. They might go up in value, although you're not allowed to write them up in US GAAP. They're assessed for impairment at least annually using either a qualitative or quantitative approach. The biggest one here is goodwill. Goodwill is bigger than property, plant, and equipment net or any other category. This is when a very specific definition in accounting. It does not mean that PepsiCo's companies are loyal to Pepsi and won't drink Coke. In accounting goodwill specific definition, it accounts when one company acquires another. PepsiCo at one point acquired Quaker Oats, and the purchase price that it paid for Quaker Oats to get control of their distribution stream and the right to market their products in total, not just having a stake, exceeded the fair market value of individual net assets acquired. We have other non-amortizable intangible assets of $12.6 billion. These include brands that are purchased, not those developed in-house. Those developed in-house, unless you're paying to defend a copyright successfully, that's the only time you'd see them on the balance sheet. You notice that they describe in management's discussion and analysis that precedes the financial statements. We believe that a brand has an indefinite life if it has a history of strong revenue and cash flow performance, and we have the intent and ability to support the brand with marketplace spending for the foreseeable future. So accounting for these things, if we don't think they're necessarily going to go down in value, we don't write them down every year or amortize them. Notice this $27 billion is much bigger than net property, plant, and equipment for non-amortizable intangible assets. Okay, what do we do with this? How do we analyze them? Analyzing assets with ratios. First is asset turnover. Net sales divided by average total assets. Net sales is from the income statement. Average total asset, add together this and last year's ending total assets, divide by 2. So net sales might be net revenues. That oftentimes we said it's the first item on the balance sheet. It's just you don't always have the same. You have a similar format in most financial statements, though different companies use slightly different wording. We have total assets at the end of the current period, which is at the end of 2017 for PepsiCo. We have total assets at the end of the prior period, which is at the end of 2016, which is still in the 2017 financial statements. So dividing net sales by average total assets, we get that we have 83 cents. It's 0.83 times. 83 cents worth of sales per dollar of average assets invested. How do you tell if this is good or bad? One way to do it is to compare it over time in a time series. Other things equal, higher asset turnover indicates you use your assets more efficiently to produce sales, and it indicates higher profitability if you have a positive profit margin and make more sales. Using asset turnover, PepsiCo was less profitable in 2017 than in 2016 because getting 83 cents worth of sales for average dollar of assets invested is not as good as generating 88 cents. I wanted to point out that if you wanted to do this for the prior year, you actually would have to get the 2016 or 2015 annual report to get total assets at the end of the prior period for the prior year. I'm only asking you to do this 1 year for your company and to compare it to PepsiCo in 2017. Okay, return on assets. It's another profitability ratio. Net income available to common shareholders on this year's income statement. Average total assets from this and last year's balance sheet. So we have net income for common shareholders, and sometimes you have net income, but some of it might be attributable to non-controlling interest subsidiaries that you own enough to control, but let's say you own 80%, but the earnings for the other 20% that you don't own, or maybe some earnings are reserved for preferred shareholders. Most of you might just have net income, but if you look for the bottom, make sure it's that is available to common shareholders. We've already looked at total assets at the end of the current and prior period. So return on assets, and again, if you want to do this for 2 years, you have to look at 2016 or 2015 annual report to get average total or to get total assets at the end of 2015. So return on assets in 2017 was 6.34%, meaning PepsiCo generated 6.34 cents of net income per every dollar of average assets invested. So that's net income after you deduct all the expenses. Higher return on assets indicates more efficient use of assets to generate profits. Using return on assets, PepsiCo was less profitable in 2017 than 2016. You would rather earn 8.84 cents per dollar of assets invested than 6.34%. So finally, we could explain return on assets with two ratios you already know. Profit margin from Chapter 5, which is net income over net sales, and asset turnover from this chapter. Looking at this formula, profit margin is net income over net sales. Asset turnover is net sales over average total assets. If you multiply these two, net sales cancels out, and that's how you get the return on asset formula, but breaking it down into components gives you insight. So if you look, PepsiCo had a lower return on assets in 2017 than in 2016, but why? Breaking it down into these two pieces help you understand. Well, not only did they have a lower profit margin in 2017, they also had a lower asset turnover. Sometimes you can't tell. Sometimes one year you'll have a higher profit margin, the other year you'll have a higher asset turnover. It's an order of magnitude. So what you would do is you can break that down to understand this ratio more. Now, feel free to use this presentation as a review before looking at other companies' annual reports for the weekly discussion board. Good luck and get started, Jaspers.